Hello and welcome to the Global View on this Thursday. I'm Andrew Gagan. Thanks for joining us again here at AusBiz as we get across those market moves overnight. Now, Wall Street bouncing back with a broad but measured rally. The three majors there all rising around 1/5%. The Russell 2000 up 0.5%. The catalyst, a surprise move by the US Treasury, which announced it would more than double the size of its debt buybacks, focusing on longer dated bonds. That sent the 30-year Treasury yield down around 8 basis points to 5.2%, which lifted risk on sentiment. Retail, that held up well after TJX, Target and Lowe's all reported solid second quarter earnings, although TJX did end up in the red. On the downside, Dell, that shed close to 7% on profit taking and insider selling, while CrowdStrike also dropping ahead of its results later. The story of the session, though, was Moderna, the biotech surging more than 170% after its personalised mRNA cancer vaccine, developed with Merck, posted positive results in a late-stage melanoma trial, and combined with Merck's Keytruda, it reduced both recurrence and spread of cancer in post-surgery patients. Well, the US Treasury unexpectedly announced an increase in buybacks of long-dated government debt, the action following a rise in yields on longer-dated maturities reaching multi-decade highs. It said it's increasing by at least double the size of liquidity support buyback operations for securities dated from the 10-year to the 30-year sector. And the Fed released minutes from its July meeting, which showed 3 FOMC members voted for a 25 basis point hike. Markets are reading at cautiously dovish, with odds of a September hold now sitting at around 65%. All eyes now shifting to Jackson Hole, where Chair Kim Walsh is expected to speak later this month. Well, the US 2-year Treasury yield rose to 4.18%, the 10-year falling back to 4.64%. Australian and 3-year government bond yield futures ranged between 4.55 and 4.58%. The 10-year was around 5.05%, I should say. The US dollar index was down around 0.7%. The Aussie climbing back to 71.2 US cents. Crude oil prices settled their highest in nearly 4 weeks as investors, concerned about escalating tensions in the Middle East after the United Arab Emirates decided to suspend all financial and economic transactions with Iran. Brent crude edging higher to around $91.50 a barrel. Gold up around 4% to a 3-month high of close to $4,520 an ounce. Copper futures off slightly, along with iron ore, which was down to $98 a tonne, and Bitcoin surging. It is close to $69,500 US. Let's get across some of those moves then. Kent Williams is joining us from Pi Funds. Kent, welcome back.
Thank you, good to be here.
That was quite the move, wasn't it, as far as that intervention by the US Treasury, and as a result we did see very much risk on sentiment come back.
Yeah, we did. I think the move that you're seeing with the Treasuries is not so much the basis point move, but it's more the indication that you're seeing from actually Kevin Walsh, Treasury. It's basically saying that there is a limit around where they're comfortable with rates being. So what the Treasury does, if it helps people, is the Treasury's job is more to manage the interest rate risk and the tenor of actually the US government's funding requirements. So effectively what they're doing is they're selling those longer dated bonds to buying the shorter dated bonds. That's how they're funding it. Effectively, from a market's perspective, what this does is, to me, it tells you that the volatility around that rate level is going to be decreased. Some people are saying this is a level where there'll be a pain point, so rates can't go higher. A few market analysts are saying actually this is really bullish long dated rates, because now it actually thinks there's some structural decline in rates here. I think it's too early to call that. For me, my takeaway here is it's bullish because the discount rate has gone down, and it gives equity markets a broad risk-on sentiment that the discount rates cannot or won't likely go up above this level. But ultimately, we've seen these sort of interventions happen before. The success of them is actually questionable in terms of how much they actually manage to do things, but what it tells the market is the Treasury is actually willing to be very active, and at this level, certainly rates long dated don't look like they're going to be moving higher, at least for the short term.
I mean, clearly the bond market has been sending those signals that it's very worried about those levels of debt. Now we've got our US national debt exceeding $40 trillion. It is eye-watering. Yeah,
and it's just that came at the day when they announced this, so it's sort of you get two things combining, which makes people question what the debt level is and how they can actually fund this. It's partly why you've seen the move in gold today, which has been a really big upward move in the fall in US dollars. So the market is telling you that actually maybe there's other places to be invested to generate returns.
Yeah, how are you seeing gold? And well, I should also note, obviously, Bitcoin getting a bit as well, because that's been under pressure, as has gold over the course of this crisis in the Middle East, of course. So would you expect then the gold's going to resume its uptrend?
Yeah, I've been actually constructive on gold for about sort of 4 weeks now. The setup is really interesting. So, it was sort of the darling asset class of 2025. It sold off pretty heavily for the last 6 months. It's found a base. Central banks are back buying. It already had a big move up a few weeks ago, then found another base, and now we've had this second move up. So for me, I think people are underinvested in gold, and this second move, plus with this Treasury announcement, is really going to cause gold to be actually something that is on people's watch list if it's not already. So I absolutely think that's something that people should be investigating if they're not already.
Ken, what's your view on equities at the moment? Let's focus on what we've seen on Wall Street, having taken out recent records at least. Just a little bit of pressure being exerted as far as the semis are concerned more recently, though. But overall, in the wake of earnings season, which is pretty much at the end, mind you, we don't have Nvidia yet, that's to come. What's your view been?
Okay, a couple of things there. So earnings season, takeaway from earnings, this has actually been one of the strongest earnings seasons we've seen in a number of years. The beats rate is well above the historical average. That's compounded by the fact that actually the lead into the earnings season was already really strong. So earnings have been upgraded into earnings season, which is not the typical thing. So the bar was already high and the actual outcome's better than historical average. So that's really, really strong for the earnings. The one cloud that I think people need to be aware of is the consumer. So the beats rate in the consumer sector hasn't actually been that exciting, actually been a bit underwhelming. We did have Target last night. We've still got Costco and Walmart. But why that matters is the consumer in the US is 2/3 of the economy. So for a really, really strong earnings season, the only wrinkle that I can see is the consumer, and that's something to probably be aware of, not to worry about at this stage.
What are the biggest risks to this bull market that we're seeing at the moment then?
Okay, good question. So semiconductors, we've seen the risk there and what that can do.
Yep.
Now, what's interesting, so in the sell-off in July, we saw the Europe markets actually make all-time highs. They're light in semis, the S&P 500 equal weight actually just kept grinding higher. So if you strip out semiconductors, the market has been really, really strong. Then you bring that back, so what's the risk in a really strong market? We've got, the consumer in the US, for everything I said, still is looking strong. Earnings season, we've just touched on that, is really strong. So I think the outlier risk, which we've just spoken about, is long-dated yields and what that does for discount rates. And you've just seen sort of the Treasury say, we're not going to be happy with higher long-dated yields. So it's given the market a bit of a green light. The setup is looking pretty weconstructive.
Is the US market your preferred market at the moment, or are you seeing opportunities elsewhere?
The US is strong. I mean, we've gone back to US exceptionalism, for want of a better term. The Kospi, Taiwan, Japanese markets did really well, but they're semi-heavy, so you haven't really seen them be as resilient in August. The US is grinding high. There's been a lot of strong earnings. There's companies like RingCentral delivering exceptional results that's starting to be rewarded. So I think the US is a really healthy fishing pond for stocks at the moment, just because there's so much breadth. So yeah, the US is pretty attractive.
Do you venture into emerging markets at all?
We do a little bit. It depends how you define emerging markets, whether you call that sort of Korea and Taiwan. I'd say they're pretty developed, but the real sort of emerging markets, not so much. India, it's a hard market to trade, but that's been a strong bull market. Thailand's the other market, which probably people don't speak about too much. Really, really strong bull market in Thailand. So we've got a few positions there as well. The economy is growing. Its governance is getting better in the stock market, and actually, in terms of ability to trade for international investors to trade, it's actually a very flexible and low-cost market to trade. Surprisingly, some markets globally are actually quite expensive. So,
Ken, we should mention Moderna.
We should.
That is an incredible move, isn't it? 177% higher off the back of that results. Have you sort of dug into that a little more?
Yeah, I think the takeaway I can give here is, that sort of share price move is something that you see very, very rarely, let alone for a company that was $25 billion market cap. So what that means for investors is, the lead in, this was being seen as a make or break sort of result or clinical trial for the company. So the share price was factoring in really, really low expectations, very much a binary outcome. The outcome we've seen has been really positive. So,
well, in fact, I guess looking at the share price, and we should note there that obviously it's still way below where it was at the height of COVID, wasn't it?
It is, yeah. takeaway here, so when you look at what the actual results are, it's the first mRNA phase 3 clinical trial to actually be successful for cancer treatment, so that's really positive. It's for the melanoma. Melanoma, the market size of melanoma is actually not big enough to justify that share price move. So what the market's telling you is there's pricing in additional cancer treatments for this. So that's the platform that the market's talking about. Where I think you go from here is, yesterday we had a stock that was deeply discounted and had huge binary outcomes. Today we've got a stock that's got much more two-sided risk, pricing in a number of things. So there's a lot of water to go under the bridge here. It's pricing in positive clinical trials. So we've still got to see positive clinical trials for other treatments now, given what the share price is pricing in.
Ken, great to get across those market moves. Thanks for joining us in Pi Funds.
Thank you.
Let's now turn our attention to where we're likely to open on this Thursday morning. There's bucking the trend because certainly over the past few sessions it's been a negative start, but SPI futures indicating a positive one there, up around 0.3%. And of course, the focus very much on reporting season. A vast number of companies to get across that. We'll do that from 10 a.m. Eastern. Join us then.